Good morning. This is Barry Knapp with Ironsides Macroeconomics. This is a weekly audio review of a note that was released on Saturday. This was the third of our three annual year-end notes, and this one was the year in review Quadrilemma. So the idea of this note was to review our perspective on what happened last year. We try to talk about some of the differentiated approaches we had to macro events and markets throughout the course of last year. We're ending the year with Treasury bear steepening, real rates pushing higher, although not today with the S&P's down 100. The Treasury market is acting as a little bit of a diversifying asset as it was historically supposed to. But the weakness in the equity market was really triggered by the significant move higher in rates. And those are, for deeper explanations about why that's the case, you could look at our outlook note or our thematic note, and you could be a full subscriber and get through all the details of this note. But in essence, the economy's been in shaky territory for some time, in as much as we do have a lot of positive things going on in the private sector, a potential productivity boom throughout the course of this business cycle. We had strong productivity readings in 2024, but we have some real policy problems to deal with. Debt management, a risky debt management approach relying on short-term bill financing to cover $2 trillion deficits and $36 trillion of debt. Those ongoing deficits are really at the core of the issue. We have a Federal Reserve that still owns some 6.5 trillion in longer term securities. Both of those are acting as that, the deficit debt related issue, the debt financing of that, and the Fed's portfolios are really overhangs that need to be cleared before we can really put policy on a more stable footing and not risk the potential productivity capital investment boom that we expect through this business cycle. So our quadrilemma idea was, in order to get the Treasury, the 10-year Treasury to stay in the vicinity of 4, we needed the Fed to cut to 4. For that to occur, we needed the unemployment rate to rise above 4 and wage growth to fall to 4. Now, we did get the unemployment rate to rise above 4 in July, and the Fed responded to that. Did cut 100 basis points, but we're still a fair bit above 4 on that policy rate. And the wage growth just fell to 4 in the final months of the year. So, we didn't quite get to that point. And as a consequence, we still have some issues to deal with from a policy perspective, which is the first topic we took on in the note. Our view throughout the course of the year that small business employment was much weaker than the BLS monthly numbers implied. That turned out to be the case. We get the big negative benchmark revision, the second biggest in history, in August. The ADP series shows very weak growth. We then went on to discuss how immigration may have cooled wage growth a bit, but only on the low end. And actually in the low end, it cooled wage growth a lot. We doubt very much that contributed to any disinflation throughout the course of the year. And we doubt that reduced immigration is going to cause an inflation spike on the way back up, as Fed officials seem to expect, which also has contributed to the shaky footing. Then we moved on to discuss inflation on balance and how it's stable, albeit at a higher trend growth rate. We got some good news at the end of the year in the housing related measures, and we do think we'll get a little bit more good news on on inflation once we get through the screwy seasonals in January. We moved on to discuss how the earnings recovery was shallow and narrow, and how the benefits of technology innovation adoption are still really only accruing to the producers of technology, not the consumers. So we haven't gotten to that point. The good news is we've had a business confidence bounce in the wake of the election, but it still needs to broaden out in order to get earnings growth from small cap sectors, mid cap sectors, the cap or the equal weighted S&P as just opposed to the cap weighted S&P, and all the other sectors beyond tech and communication services. Also in this note was a pretty long discussion about financial sector deregulation and how that progressed through the course of last year, and how we're encouraged that that will be a big macro positive in 2025. And then we talked a lot about the painful disinversion of the curve. The curve did disinvert. That will relieve pressure on small banks. We didn't really do it the right way. We didn't get enough policy rate cutting. We got 100 basis points. We would have liked to see something more like 150. We think we will get another 100 next year. That was in our outlook note, which we hope you all took a look at, because we did put it outside the client paywall. But on balance, the Trump administration is, inheriting an economy that's on somewhat shaky footing, and certainly a policy mix that is fairly toxic. So they have their work cut out for them. We know the market's been optimistic about the incoming economic team. We think the economic team is quite good. Steve Moran being named head of the NEC was the latest appointment, but again, they've got their challenges. So that's it for me. We'll get back on our regular schedule on Friday. We hope you all have a very merry New Year, happy New Year. Thank you.